active versus passive. It's a rivalry as old as the Hatfields and McCoys, the North versus the South, and I guess here in Chicago, the Cubs and the Cardinals. Tim Clift of Envestnet. Tim, what do you think of this rivalry between active and passive? Is it really that old?
I don't know if it's quite that old. Passive hasn't been around as long, and I think the dynamics is changing. I think it's really a debate between higher cost and lower cost rather than just active and passive. It's not really about the investment vehicle.
Right.
It's really about, does it make sense to have active manager trying to beat benchmarks or just track the benchmarks?
So it's at least as old as Beavis and Butthead, though, right?
Yes, actually. What is that, mid-'80s? Yeah,
Exactly. 90s, yeah. So, I mean, it's interesting because I think there's been this shift over the past decade from active to passive because of a lot of the cost structure here. What do you think? I mean, is there enough alpha to make up for kind of the cost of active management?
I think active management and alpha is harder to find today. I think, in a lot of categories, in general, active managers fail to beat the benchmark. But there are categories where they do win. And it's maybe only 20% or 30%, but there's still 20 or 30% of them that are winning. So you have to dig harder to find these types of managers that are going to be able to beat the benchmarks. But it can be done. It can be done.
So in a good portfolio, should there be a mix of these kind of products in there?
I do think so. I think a mix is best because there's certain environments where active managers will do better. They typically do better when the markets go down. They tend to be a little more conservative. They can make adjustments to the portfolio. With passive, you're going to get the entire benchmark downside performance. And also, depending on correlations in the market or volatility, active or passive may be doing better or worse. So I think understanding the macro conditions that are going on, you can actually make changes to those portfolios based on that.
So in today's market conditions, what are your thoughts? What's kind of the mix that advisors and ultimately their investors should have in a portfolio?
Yeah, so I think it comes down to asset categories for one. So there's some asset categories that tend to be better to go passive in if there's a whole lot of information already about the stocks that are in there, like a large cap, for example, or some fixed income categories. It may be a little better to go passive, or at least it's harder to find active managers that do well. So creating a portfolio like that can definitely make sense.
So is it alternative strategies you think where active can really make a difference then? If there's some of these fixed income is better for passive, what are some good active kind of portfolio sectors?
So by and large, small cap tends to be able to outperform, or you see, because it's a bigger universe, they're not as covered securities. Some of the sectors, but again, I think it ebbs and flows. So it's not necessarily a 50-50%. Right now, it's looking a little bit better for active. Right now, particularly when you have flattish markets and really volatile markets, you tend to have these correlations that get they spike. Instead of going together, big swings up or big swings down, you tend to have everything move together. Right now, we're having extremes in the different categories, and that tends to be a better stock picking environment for active managers. So we're a little bit overweight there.
And I think when we especially look at different types of investors, some are better suited for active versus passive. I think a lot of passive products are in retirement funds. Is there a specific kind of investor you think is better suited for one over the other?
I don't really think it goes to the investor level, although some investors, all they care about is cost. Right? If all they care about is cost, then passive is going to be probably the better fit for them. But it's not necessarily a retirement thing. Although with the new DOL regulations that we're looking at, that's putting more pressure on cost for sure. Yes. And so that retirement accounts in particular are looking at lower cost options. Again, it's not necessarily just ETFs. It could be index mutual funds or just low cost mutual funds. But cost is becoming a driving factor now.
So last question, what's the biggest mistake that advisors and clients really make when trying to decide, should I be active or should I be passive? And how do you correct that mistake?
Yeah, I think the biggest mistake is that it's all or nothing, that you have to be in one camp or the other, and I think that's a mistake. I think blending of the two is a fantastic way to build a portfolio, and you can make adjustments, you can do kind of core satellite, you can look at what the markets are doing. So it's not, it's not one wins and one loses, it's blending them together.
Absolutely. Tim, thanks so much. Great insights, and I really appreciate talking to you.
Great, thanks for having me.
Absolutely. For Investment News, I'm Matt Ackerman.